In the year 2025, the world of digital assets stood at a formidable crossroads, a landscape marked by both the echoes of past exuberance and the shadows of caution. The cryptocurrency market, once a beacon of innovation and opportunity, had experienced its share of tumultuous highs and devastating lows. As the dust began to settle from the upheavals of previous years, a new narrative emerged, one that spoke of resilience, adaptation, and a potential resurgence of faith in the digital economy. The decade began with a surge of enthusiasm for cryptocurrencies, driven by the promise of decentralization, transparency, and financial inclusion. Bitcoin, Ethereum, and a plethora of altcoins captured the imagination of investors, technologists, and everyday people alike. Yet, as the market matured, it faced significant challenges: regulatory scrutiny, security breaches, and the environmental impact of mining operations. By 2025, these challenges had catalyzed a transformation within the cryptocurrency landscape, leading to a more robust and sustainable ecosystem. One of the most notable developments was the establishment of comprehensive regulatory frameworks across various jurisdictions. Governments, initially hesitant to embrace digital assets, began to recognize their potential to revolutionize finance. Countries like the United States, the European Union, and even emerging markets in Africa and Asia implemented clear guidelines that fostered innovation while ensuring consumer protection. This regulatory clarity instilled a renewed sense of legitimacy in the market, attracting institutional investors who had previously remained on the sidelines. With the advent of regulation came the rise of central bank digital currencies, CBDCs. By 2025, several countries had launched their own digital currencies, aiming to provide a stable alternative to volatile cryptocurrencies. The introduction of CBDCs posed both a challenge and an opportunity for the existing cryptocurrency market. On one hand, it threatened to undermine the appeal of decentralized currencies. On the other, it validated the underlying technology and opened the door for collaboration between traditional finance and the crypto world. The coexistence of CBDCs and cryptocurrencies led to a more nuanced understanding of digital assets, where consumers could choose between the stability of government-backed currencies and the potential for innovation offered by decentralized options. As digital assets became more integrated into the financial system, the technology underpinning them also evolved. Blockchain, the foundational technology of cryptocurrencies, saw significant advancements in scalability and interoperability. Layer 2 solutions and cross-chain protocols emerged, allowing for faster transactions and seamless exchanges between different blockchain networks. This technological evolution not only improved user experience, but also attracted new use cases beyond mere speculation. Decentralized finance, DeFi platforms, matured, offering a range of financial services, from lending and borrowing to insurance and asset management, without the need for traditional intermediaries. The DeFi space became a playground for innovation, with new financial instruments and products designed to cater to a diverse audience. However, the path to recovery was not without its obstacles. The cryptocurrency market continued to grapple with the specter of fraud and security breaches. High-profile hacks and scams served as painful reminders of the risks inherent in the digital asset space. In response, the industry rallied around the need for enhanced security measures and best practices. Projects focused on building robust security protocols, while educational initiatives aimed to empower users to protect their assets. The emergence of decentralized identity solutions also played a crucial role in enhancing security, allowing users to maintain control over their personal information while engaging in the digital economy. Moreover, environmental concerns surrounding cryptocurrency mining persisted, particularly in the wake of growing awareness about climate change. The energy consumption associated with proof-of-work mining came under scrutiny, prompting many projects to explore more sustainable alternatives. By 2025, a significant shift had occurred, with several major cryptocurrencies transitioning to proof-of-stake mechanisms or other eco-friendly consensus algorithms. This pivot not only addressed environmental concerns, but also appealed to a more socially conscious investor base, further legitimizing the industry. As the cryptocurrency market stabilized, the narrative surrounding digital assets began to shift from one of speculation to one of utility. Businesses, both large and small, started to integrate cryptocurrencies into their operations. E-commerce platforms began accepting Bitcoin and other digital currencies as payment, while forward-thinking companies explored the potential of blockchain technology for supply chain management, identity verification, and more. The concept of tokenization gained traction, allowing real-world assets, such as real estate, art, and commodities, to be represented and traded on blockchain networks. This democratization of asset ownership opened new avenues for investment and participation in the economy. The interplay between digital assets and traditional finance continued to evolve, with banks and financial institutions increasingly recognizing the need to adapt. Many established players began to offer crypto custody services, enabling their clients to securely hold and manage digital assets. Investment firms launched cryptocurrency-focused funds, catering to a growing appetite for exposure to the asset class. The lines between traditional finance and the cryptocurrency world blurred, leading to a more integrated financial ecosystem. Despite these advancements, the cryptocurrency landscape remained a complex and dynamic environment. Market volatility persisted, with prices often swayed by regulatory announcements, technological breakthroughs, and macroeconomic trends. Investors learned to navigate this volatility, adopting a more cautious and informed approach. The days of reckless speculation gave way to a more strategic mindset, as individuals sought to understand the fundamentals of the projects they supported. This maturation of the investor base contributed to a more stable market, where long-term value creation took precedence over short-term gains. As 2025 progressed, the narrative of a crypto comeback began to take shape. The market experienced a resurgence in interest, driven by a combination of regulatory clarity, technological innovation, and growing acceptance among business and consumers. Bitcoin, once again, became a focal point, not merely as a speculative asset, but as a store of value akin to digital gold. Institutional investors, having weathered the storms of previous years, began to allocate significant portions of their portfolios to cryptocurrencies, viewing them as a hedge against inflation and economic uncertainty. The media, which had once sensationalized the rise and fall of cryptocurrencies, shifted its tone. Coverage began to focus on the transformative potential of blockchain technology and the real-world applications of digital assets. Success stories of entrepreneurs leveraging cryptocurrencies to build innovative solutions emerged, showcasing the positive impact of the technology on various sectors. The narrative evolved from one of skepticism to one of optimism, as the broader public began to recognize the potential for digital assets to drive positive change. Yet, amidst this resurgence, the specter of a potential collapse loomed. The cryptocurrency market remained susceptible to external shocks, whether from regulatory crackdowns, technological failures, or macroeconomic shifts. The lessons learned from previous cycles served as a reminder that the journey toward mainstream adoption would not be linear. Investors and enthusiasts alike understood that the road ahead would require vigilance, adaptability, and a commitment to building a sustainable and inclusive digital economy. In this evolving landscape, the importance of community became increasingly evident. The cryptocurrency space had always thrived on the passion and dedication of its participants, and as the market matured, this sense of community grew stronger. Online forums, social media groups, and local meetups became hubs of knowledge sharing and collaboration. Developers, investors, and users joined forces to advocate for best practices, support emerging projects, and foster an environment of innovation. This collaborative spirit became a cornerstone of the cryptocurrency ecosystem, reinforcing the idea that the future of digital assets would be shaped not only by technology, but by the people behind it. As 2025 drew to a close, the cryptocurrency landscape stood as a testament to resilience and evolution. The potential for a crypto comeback was palpable, but it was tempered by the lessons of the past. The market had learned to embrace regulation, prioritize security, and championed sustainability. The integration of digital assets into the fabric of everyday life was no longer a distant dream. It was becoming a reality. In this new era, the possibilities for digital assets seemed boundless. The narrative of the cryptocurrency market was no longer defined solely by the volatility of prices or the allure of quick gains. Instead, it was a story of innovation, collaboration, and the pursuit of a more equitable financial system. As individuals and institutions alike navigated this uncharted territory, they were united by a shared belief in the transformative power of digital assets, a belief that, despite the challenges ahead, the future held immense promise for those willing to embrace it. Subscribe now for more.